Hi, everybody. Hopefully we've all logged in and you're ready to listen to our webinar today. Congratulations on coming aboard. And it's great to be able to get together this time just to run through quite a few things that have been happening in the world. And we're going to be focusing today on the Omicron impact on our economy and particularly supply chains. Firstly, wherever you are, hopefully you're doing really well. Hopefully you're keeping safe and strong. And most of us here are in Auckland, and some of us had Omicron, and we've been recovering well. So hopefully we are over the peak of those cases, and we're on the downhill slide to normality, whatever that might be in the future. But our guest today is going to be talking about what that impact of Omicron is going to be on the economy. It's a big impact. I don't think we've seen the last of it yet. It's going to last for a while. So Christina Leung, she is the principal economist and head of Auckland business at the New Zealand Institute of Economic Research. I had to read that because it's a very long title. So definitely she knows what she's talking about, and talking to us today about the economy, inflation, supply chains, all those things that have been on our minds. And there's time during the session where you could type in some questions. So as you're listening, if you've got some questions that you've got, please type them into the chat function. If you move your mouse along your screen, you'll see a little chat button that comes up at the bottom, and you can just type away in there, and we'll cover those questions off at the end. So we'll make sure that we do cover your questions there. So ask anything that you like. After Christina, we're going to have Cam Harper. He's one of our managing partners, and he's going to give you an overview of some of the trends that we're seeing across our business. And again, you can ask questions as Cam is going through his presentation, and we'll cover those off at the end as well. But before I start with the Q&A with Christina, just want to remind you that this information is of general nature. So if you've got any specific objectives or circumstances with your investing, we do always suggest you talk to a financial advisor to get what's best for you in your circumstances. Right, so welcome, Christina. It's great to see you again, and thanks so much for taking the time.
Thanks for having me on.
So it's been, well, November was the last time we spoke to you, and we felt like Delta was the biggest thing we were going to get out of COVID. But of course, Omicron's come along. So how do you think New Zealand's economy has been impacted, particularly with Omicron, and what do you think this means for our economic future?
Yes, how quickly things change, right? Delta is so last year, literally speaking. So with the latest Omicron surge widespread across the country, what we're seeing is a change in behaviour as well. Now, even with the restrictions having been relaxed back in December last year, what we're seeing is that fears of infection or just having to self-isolate has meant that a lot more people are restricting their movements. We're seeing this come through in particular sectors, so such as services sector, particularly most apparent in hospitality, but also across the regions as well. So within certain regions, certainly if you look at, say, Auckland, the central business district is a lot quieter as people choose to work from home. So a lot of the activity has been pushed out to the suburbs, but also across New Zealand. If you look at regions such as Queenstown, which is quite reliant on Auckland tourists, we've seen those areas become quieter as a result of just that increased caution around and people having to self-isolate. Now, that's the demand side of things. On the supply side, what we're seeing is staff shortages, and that's the result of people having to self-isolate due to infection or having being household contacts, and also the flow-on impact of global supply chain disruptions, with port congestion here and abroad affecting the ability of businesses to source inventory to restock shelves for production or for sale. At a broader level, we're seeing this heightened level of uncertainty, and what that means is that both businesses and households are a bit more cautious when it comes to spending and investment. Now, businesses hate uncertainty, and we've seen that over the history of our NZIER quarterly survey of business opinion, is that at times of high uncertainty, what we see is that businesses tend to pare back on things such as large-scale investment, just because it makes that planning over the longer term that much harder. So what that tends to mean is that it becomes a self-fulfilling prophecy, as that caution and people holding back on activity then in itself leads to reduced activity down the track.
Absolutely. And you talked about staff shortages and the ability of businesses to get inventory. Of course, anyone that's been to the supermarket recently can see all the empty shelves. I tried to get cat food the other day. I'm not quite going to go down the salmon route. I'm not going to spoil it that much, but it's very, very difficult, and you must feel for businesses at the moment. But when we specifically for our investors and what we do here, it's the construction industry. So what do you see as the future for the construction and supply chains in New Zealand? Because the media, we see a lot of scaremongering in the media. You know, you only got to see one headline and you think the whole thing's going to fall apart. But our construction partners are telling us that everything's ticking along really well. So what do you see at the macro level?
So there is a wide range of experiences across the industries, and the degree to which how businesses fare does depend to a large degree on how well businesses have planned ahead. Certainly those that have planned and make sure to have enough inventory for the coming months have been more resilient against these disruptions. Overall, at a broader level, though, what we've seen is that global supply chain disruptions have affected the supply of building materials, which, along with labour shortages, has pushed up construction cost inflation. Now, when we look at across the different subsectors of constructions, residential construction cost inflation has been particularly strong. So that indicates that this part of the construction sector is where capacity constraints have been most acute. Looking at the quarterly growth rate, though, when it comes to costs, the situation is one where it appears that cost inflation remains high, but is not accelerating. Our own NZIER quarterly survey of business opinion shows that materials and supplies has become a major constraint for for more of the building sector firms. Now, with almost 23% of building sector firms naming that as the primary constraint on their business. So that's quite a jump from the 2% naming materials as their primary constraint earlier in 2021. But that actually pales in comparison to the other sectors where, for example, 45% of retailers name the materials as the primary constraint on their business in the December quarter. So what we see is that these global supply chain disruptions are having an impact across many sectors of the New Zealand economy, including the construction sector. And it really comes down to how well businesses have managed to plan ahead when it comes to managing their inventory for the months ahead.
Yeah, I must say that, you know, your comments about the businesses able to plan ahead and stockpile, we're actually getting similar feedback from our borrowers that are doing construction, that they have stockpiled, they have got the materials there, or they've got extremely good relationships with the suppliers. So that sort of mirrors what we're hearing from our construction partners too. And at the end of last year, of course, big talk about inflation, strong inflation pressures in New Zealand's economy, but we didn't know what was really going to be in store for us. So what are you forecasting? This is crystal ball now. What are you forecasting in terms of inflation? And specifically, what will this mean for interest rates, bank deposit rates, particularly those investment rates ahead? I think our investors are really keen to hear that.
So at the moment, first looking at inflation, what we've seen is that we've seen a strong increase in inflation across many areas. So it's quite a broad-based increase in prices across the basket, the CPI basket. So we're forecasting annual CPI inflation to peak at over 6% at almost 7% over the coming year. Now, of course, that's well above the Reserve Bank's 1 to 3% inflation target band. And what that means is that for the Reserve Bank, they would be keen to rein in inflation. Now, this is not as straightforward as it seems. While they have an inflation target band, the fact that a lot of these strong price increases reflects supply constraints rather than the demand side of things does make it trickier to manage. For example, you only have to think back to the 1970s of the oil price shock, where we had high inflation as a result of concerns about oil supply. And as a result, by responding with high interest rates, what you risk is that you constrain activity even further while inflation remains high. Where we are now is that it is actually a bit of a supply and demand story. The fact that with demand still being fairly resilient, it is allowing businesses, and we've seen that come through in our quarterly survey of business opinion results, asking businesses have reported it being generally easier to pass on higher costs by raising prices for customers. So what that means is that we're seeing inflation increase as a result of both supply constraints and demand still being resilient enough for businesses to be putting these price increases through. What that all boils down to for the Reserve Bank is that they're very mindful of not wanting to ignite a wage price spiral. So that's when, because prices are higher, workers demand higher wages to cover their high living costs, and that in turn means increased labor costs, for which businesses then increase prices. So you get this spiral coming through and inflation continuing to accelerate as a result. What we're seeing is that longer term inflation expectations are picking up quite markedly, and in particular the 2-year ahead inflation expectations rising above the Reserve Bank's 1 to 3% inflation targeted band. So for the Reserve Bank, being very mindful of not wanting inflation expectations to become unanchored, they will be responding with higher interest rates over the coming year. Now, of course, the big question is how fast and how much they'll go over the coming years. So given the intensification of inflation pressures, there's been increasing talk that the Reserve Bank will put through 50 basis point OCR increases at the upcoming meetings, and for the OCR to reach a peak of around 3.5% by early next year. Where we see things is that represents, from the current 1% OCR, quite a sharp increase in interest rates over the coming year. We've already seen interest rate OCR increases come through in both high mortgage rates and high term deposit rates. For a lot of the mortgage rate holders, though, if we look at Reserve Bank data, around 60% of mortgages are still not due for repricing until at least another 6 months. So what that means is that we haven't seen the full effects of high mortgage rates just yet. And we expect that later this year, as more households roll off these fixed mortgage rates with the 2% handle onto mortgage rates with more of a 4 or 5% handle, then the pain of high mortgage rates will become more apparent. So we're seeing already the effects of high mortgage rates come through in reduced borrowing for new mortgages, but also as mortgage repayments increase over the coming year, that's likely to see households rein in discretionary spending. So overall, we do not see the OCR going up to quite the degree that markets are currently expecting, just with the fact that as interest rates continue to increase, then the negative impact on activity, we expect that will be enough to slow inflation down to the 1 to 3% target band. What that all means for mortgage rates and term deposit rates is that, yes, we're going to see further increases ahead, but not as the degree to which markets are currently expecting.
Right. And I suppose when those mortgage rates are due for refixing, the majority of them, as you said, 60%, I wonder how many investors will be looking at their, their rate of return that they're getting, and whether they're better off to quit some of their property and consolidate a little bit. So it'll be interesting to see if that happens, and then how that increases the supply of houses around. So putting everything we've talked about, which, it's the Omicron impact on the economy, the supply chains, inflation, everything like that, how is that going to impact house prices and investments? That's probably the most important thing that our investors are looking at. What do you see? Is it going to flatten off? Are we going to have a rise or a drop? What do you think is going to happen with all that?
And your earlier point about the fact that as mortgage rates continue to increase, that will get property investors looking a lot harder at whether the rate of return stacks up against the cost of borrowing. You're right. And even in the recent NZIER housing market data, we're already seeing that pick up in houses being put on the market, so that increase in listings. So already there's more of a more housing supply on the market as investors reassess how well their investments are working for them when it comes to rate of return. Also, as I was talking about with high mortgage rates, that's reducing the demand for borrowing. And what we're seeing is that already we're starting to see that easing in housing market activity. And we've seen that since December last year. While this easing in demand has been concentrated in Auckland, given that Auckland tends to be leading indicator of the housing market nationwide, we would expect this easing to broaden to the other regions over the coming year. So what we're seeing, putting it all together, is that picking up in the supply of houses being put on the market, and then on the demand side with high interest rates starting to take some of that demand out when it comes to housing demand, we are seeing an easing in house prices. Now, how much prices will fall? Of course, there's always a large degree of uncertainty when it comes to that. We only have to think back to the beginning of the pandemic, where many were expecting house prices to fall sharply. And what we saw instead was that house prices rose, and that was in response to the unprecedented amount of stimulus put in place by both the government and the Reserve Bank in the form of low interest rates and relaxed lending requirements. So thinking what this all indicates is that policymakers, so for the government and the Reserve Bank, they would be quite reluctant to engineer a significant slowing in the economy. So any signs that this increase in mortgage rates will start to have too much of a hard landing for the economy, we're likely to see them become more cautious about continuing to tighten monetary conditions. So as I was saying earlier, that is why we don't expect that interest rates will rise to quite the degree that markets currently are expecting. Overall, we expect that high interest rates will weigh on demand for assets, so houses and also with shares. So we do expect that we are looking at an environment of lower return for investments, except for fixed income. So when it comes to term deposit rates, that tends to rise in line with OCR. So in this environment of rising interest rates, we would expect those to continue to pick up over the coming years. But when it comes to other investments such as shares and houses, then that we're going to see the rate of return start to ease off from there, given the lower demand.
Excellent, excellent. Thank you so much, Christina. It's been extremely insightful. And I also believe it gives us a lot more confidence in property as an investment. And we look forward to reading a bit of an update you'll give us in our next newsletter. Of course, as you've been listening to this, it's a lot of information to take in. So be assured we've recorded this webinar and we can send it out to you. We'll be sending it out in the next few days to everybody. So you will get a recording of this and you can play back Christina's amazing information that she's given us. Again, please type some questions into the chat function. But again, thank you so much, Christina. You've been amazing. So now I'm going to hand over to Cam to find out, well, how is this impacting our business? What's happening with Southern Cross at the moment? And again, you've got some questions, put them in the chat function and we'll answer them at the end. So over to you, Cam.
Thank you, Heather. Much appreciated. And hello, everybody. And good to have you all along today. I will start by saying we have seen one question so far, which I answered from Chris. Chris says, when I joined with you in 2017, return rates were from 6.25 to 7.5 range. They're now in the 5 to 6 range, starting to equal CPI. Why are the latest offerings not higher? Look, it's a very valid question, and it goes a lot into what Christina and Heather have been talking about. So I'll just read what I went back with, and I'll reiterate something at the end. But as I say to Chris in this question, it is a massive balance for us between remaining competitive with the loans that we take on to the return we give our investors. Then obviously the margin that we hold, which runs the business. We have a team of 27 who run this business, and so we need to make sure that we get that balance right. We constantly review our rates, both for investment and for lending, and we will continue to do that as well. So if you need any more clarity, though, I would suggest to anybody, give one of us a call. Ring Ross, ring Simone, ring Heather, Victoria, ring me. It doesn't stress me too much who you call. Just give someone a call and we'll be able to go through those with anyone at any time. So, and as Heather says, just type up any questions that you have, just fire them through. And if you think of one afterwards, think, man, I wish I'd asked that, then please come to one of the team. So look, I'll just kick this off by saying, you know, for anyone who doesn't understand, if you're new to us, we are a business with two distinct sides at Southern Cross. We have one of our teams works exclusively with financial advisors. In the old days, they were called mortgage brokers, but they're obviously a lot more upskilled than potentially things have been in the past. Been a real push to get financial advisors to do exactly that, financial advice. And as Heather was saying, we'd always say to any of our investors and borrowers, make sure you do get good financial advice to what suits your scenario at that time. So we work with financial advisors. We only take on the best loans. You know, we really do only take on ones that we're comfortable to take on. So we fund those loans with our own cash, the cash that we hold as a business, we fund that. So we'd only invest in loans that we are willing to invest in ourselves. We don't put our investors' money up first, we put our money up first. And then you as investors then invest in those loans through our investor portal. I'll actually just say something we didn't cover off, and a lot of you have been someone will probably ask this question, so I'll cover it off before we get there, about our new investor portal. We've been talking about this for a long, long time, haven't we? For those of you that have been with us for a while. So at the moment, we have our finance system that runs this entire business is called FinPower. So we have a major upgrade of FinPower, and that takes place at the end of this month. It's locked in stone. We're doing it. The 31st of March, we do the transfer. So that's only, looking at my watch, less than 2 weeks away. It's on 2 weeks away now. This Friday, 2 weeks as we turn it off, or Thursday. And our new one starts on April the 4th. So from there, the first thing we'll roll out from there will be the investor portal. So Heather and I are thinking that'll be around the back end of May, the start of June is what we're aiming for, but we'll have more information on that as it comes to hand. But anyway, so when we find a loan that comes through to one of our sales team, we analyze that loan. So it gets an initial assessment by one of our sales team. And our sales team, we have 3 people who are our business development managers, Hen, Nick, and Michael. And then they will do an initial assessment. Is this something we're looking for? They understand the strike zone of the loans we try and take on. So then they'll look at it and go, no, it's not really for us. It might be, it could be anything. It could be, I don't know, rural, for example. We don't do farms. It's not our wheelhouse. It's not our area of expertise. We may look at it and go, we've actually got a lot of bare land on our books at this point in time. We don't right now, but say we did, they may go, no, we don't want any more bare land at this point. Thank you very much. So they do that initial assessment. From there, it'll generally then go to our credit team, Mark and Arishma. So they'll go to them and they will then analyze the loan. And especially and I'll talk about construction a bit later on, but we look through a whole lot of things to do with that. And I won't get onto that yet because I've got it in my notes a little bit later. So once that's done, we put our money in there, we fund the loan, they have the drawdown date, it all gets processed, then goes on the investor portal, and the investors can then go through and do that. So that's invest in that. So, you know, rates are always changing, like I was saying earlier, subject to availability as well. But at the moment, minimum rates start from 5, minimum investment is $10,000. And that'll, you know, as I said, pick up the phone, have a chat to one of the team, and they'll be able to fill you in with further details on that. Something else I want to share as well is something we're very, very proud of is April the 1st, and it's sort of the way it worked out with the financial years. April the 1st this year is the 25th anniversary of Southern Cross for us, 25 years. And I think when you look at everything, and you guys, most of you will remember what the last 25 years has been like, there has definitely been our share of ups and downs. But been a very, very successful time, and something we're exceptionally proud of is to be 25 years in business. For any business to do that is incredible. And for us at Southern Cross, we are very, very proud that we will be in 25 years. You know, we are expecting the year ahead, this next financial year, to be challenging, but the last 2 have been challenging as well. And look, we came through the global financial crisis, came through a lot of different things, excuse me. And we are, like I was saying earlier, we constantly recalibrating the business to make sure that we are armed for what's ahead of us. And I truly believe that we are very well armed for what lies ahead through 2022-23 financial year. So one thing we did see when Omicron really hit, and something you as investors will see as well, is an uptick in the number of loan renewals. And we have seen a few, but we do expect those to drop to normal levels in the near future. And I think that, so loan renewal is when a loan term ends and we renew the loan agreement to give them an extension because they haven't been able to achieve their exit. Now, that doesn't mean that there's something wrong with the loan. The ones we're seeing really are the effect of, this is in construction, is because not really anything to do with supply, it's supply of staff. It's as plain and simple as that. And I was talking to somebody about this recently. You go to, not many of us are traipsing around building sites. We do here at our work, but I wouldn't expect anybody else to be doing so unless you're building something yourself. But you only need a couple of staff to be off, don't you? Isolating because either they have Omicron or one of their family members has Omicron. So that you just need a couple of key staff members to go down and suddenly it grinds to a halt. I was talking to somebody recently who is a bench top installer. That's what he does. He manufactures and installs bench tops. There's him, and he has 5 staff. And of those 5 staff, one of them was on leave because his partner just had a baby, and the other 4 either had Omicron or were isolating. So his business ground to a halt for 7 days, and then obviously that exacerbates as he try and catch up. So when we renew a loan, like I say, there's nothing wrong with the loan itself, but we do renew it to give these people a chance to catch up. And we have found they've actually caught up quite quickly and quite rapidly. Be assured though that all those loans and those investments do remain valid. They'll continue to earn you interest, and the loan will be repaid. And we also, when we do renewals, we don't just roll them over. We don't just roll over loans. That's just not what we do. We put them straight back through the same criteria as when we took the loan on any new loan. So does this loan still stack up? Is it something we still want to be invested in? Or do we need to actually say to them, look, you know what, we need you to do this for us, do that for it. We might put some extra conditions on it. It's fairly rare that we do that, but we just want to make sure that we're ahead of where we are. And I was going to say, with builders having to isolate, it might be plumbers or whomever, and even down to, you think about the wider picture of things. I heard something recently, some people trying to get some aluminium windows, and the aluminium window joinery place, a whole lot of guys in their factory were isolating. It's just the times we live in, isn't it? But it looks like this wave is now passing us, so hopefully we can get into some sort of normal service quite rapidly. But like I was saying, with renewals, we do expect them to drop back to normal levels in the very near future. Second thing I was going to have a quick chat about was, we have seen an acceleration. This has been for the last couple of years now, of people coming direct to Southern Cross as opposed to through their financial advisor, coming direct to us rather than going through the banks. And we are seeing that quite regularly. So it does also mean we've been more selective than we have ever been. Quite often you get people that go to the banks first. The bank says, yep, we're good to do that loan, or no, we're not. We have seen an increase of people that come direct to specialist lenders such as ourselves and maybe some of our competitors to see what they to just do the deal directly with us, because we are a lot quicker when it comes to assessing the loan. It doesn't mean that we're taking any shortcuts. It just means that we've got faster, more streamlined processes to actually get the money to the people that need them and get them going quite quickly. But we do spend time getting to know the situation of the person that we are lending money to. So why do they need the money? How are they going to achieve their exit? That is really, really important. Can they get a clear exit? How are they going to exit our loan from us? How is that loan going to mature, then repay? And then obviously we repay you as investors. So we spend a lot of time on that. Can they make the repayments? We spend a lot of time. Can they actually make the repayments for this loan? A lot of people can't. And we say, look, regrettably, we can't do this for you because that you fail in that area. And then, a solid valuation. We really look at valuations. I'll talk a bit more about that in the near future, but valuations to us are exceptionally important. Does the perceived value from the borrower actually stack up? We will often hear, assumed value is X dollars, or the neighbour's place sold for X, therefore our place is worth that. That's not strong enough for us. Look, it's a factor, but it's not strong enough for us to actually look at. And also we see quite a few people that will turn up, they want to settle investment properties. We do see a lot of that, or somebody for future construction. They want to settle, it'll be a house, and we can see the unitary plans, especially here in Auckland, like them or not with the unitary plans, people will buy a property. It might be one house with a whole lot of dwellings on it, and they want to hold on to that for 12 months or 18 months until they've finished their first project and move on to that one. So we do see quite a few of those ones come along as well. But, you know, we assess those as, sometimes we'll assess them as dwellings, or we will assess them just as bare land, depending on is there any value in the house sitting on that section at that point in time. Quite often there is, sometimes there's not, but that's all part of our assessment as well. So the next point I wanted to have a quick chat about, the last thing I'd say on the last one though, is we are very, very clear on what sort of loans work for us, and therefore what sort of loans work for you, our investors. So what loans are in our strike zone that we know that you guys will be confident to be able to invest in if that's the choice that you make. So we do look at that and to make sure that's going to work. So we are definitely saying no to plenty of applications, but we're also finding the overall quality of the loans, and this is something that Heather and the team talk about regularly, is quality over quantity. You know, we want to make sure we're doing quality loans as opposed to just filling up the portal with whatever turns up. That's not what we do. We've never done that, and we're not about to start now. Construction loans. I want to have a quick talk about that. You know, construction, you just need to go for your walk in the morning, don't you, to understand that there's a lot of construction happening right around the country. And, you know, we've had periods of time where we've had a lot of applications come in, but there are also periods of time that we assess all of those on their merits, but we will actually slow that down. We do slow that down. We've been going through a period of that in recent times, of just slowing it down to see what the effect of Omicron was. We did the same thing with Delta. We did the same thing with Alpha. And we've done that right through the 25 years of this business. But we want to make sure that construction doesn't dominate our portfolio. You know, you could probably open the gates and do 100% of our loan book could be construction, but that's not a good place to be, is it? You guys all know that, you're savvy people. So we've got to make sure that that doesn't happen. But on the whole, our construction partners, the biggest constraint they are finding is what Christina was talking about earlier, and is what I've mentioned as well, and that is having staff isolating. That's the biggest issue they seem to be, but it is still ticking over well. That labour shortage is difficult for them, and it's a twofold labour shortage that our partners are reporting. First is having teams isolating because of COVID, but also and Christina talked about this earlier, we don't have immigration at this point in time. Usually builders are able to get some extra labourers or leading hands. I mean, you look at any builder, they're all trying to find staff right now. And so we have to balance that, and it's one of the key questions we ask any developer. Do you have the suppliers to get you through? As in, you know, we talk about, we all saw the article, didn't we, about how there's no jib supply. Well, you know, that's not really the case. If the developer has a good relationship and they've been stockpiling, that it's not an issue for them. But we say to them, do you have the materials to finish this job? And do you have the labor to finish this job? The two of the key questions we ask right at the top. A lot of applications, as I was saying, for construction. And like I was saying earlier, it's generally people that will buy a section, the good old quarter acre, which seems to be a long way in the past these days, doesn't it? But it'll have a house on there on whatever size section it is, 600, 700, 800, maybe 1,000 squares, 1,500 squares, who knows? And they'll build 2, 3, 4, 6, 8 even houses on that property. And also you'll see, we have seen a few of them, but you'll see neighbours banding together to sell both their houses at the same time to a developer. So the developer doesn't have to worry about height to boundary ratios and things like that. So we see for that. But, you know, like I've been saying, we're taking a cautious approach to construction, and very good with our team. They are very good at letting the financial advisors know exactly what we're after and exactly what we're not, what our appetite is like at any point in time and what it's not. So that helps us a lot. So the due diligence that we need to have for construction is high, and it keeps getting higher. You know, we constantly review, is our due diligence strong enough? and there is no such question as no, it's not. If we need to add something in to get surety, then we will do so. We do site checks and site visits. So that will be at the time of application. We'll go and actually talk to the developer, the borrower, and often meet the builder. Then we'll also go through to make sure over that period of time, we'll do site visits over the period of time of the loan to make sure they're performing, making sure that, and then we'll often, we also do what's called progressive drawdown. So we don't give them all the money at the start of the loan. We give them enough money to start themselves up. Then when they have progress payments as they go through. So the first progress payment may be when when all the pads down, they've done all of the groundwork and the concrete pad is down. They send us the invoices along with some, we may do a site visit, or they may send us photos and videos to prove that they've actually done that. And the council signed off that part. We then pay them. Then they start into the next part, and that's how it works. So we have always got a tight rein on where our construction is at any point in time, because we need to know where the money's going. You know, it's as easy as that, isn't it? And the last point I'll do here, and if anyone's got any questions, is a tight focus on property valuations. You only need to, you know, I think most of us have got the email over the last few days if you are living in Auckland, and it's the same for right around the rest of the country. All our new CVs have just, our council valuations have just arrived, and you know, you sort of go, goodness me, that's a heck of a lot when it comes to my rates, isn't it? But we know that some of them have been, valuations are eye-wateringly high, and we look at that and going, is that a true reflection of the market? And you know, the Auckland Council has just got a stat given to me recently. It announced an average 34% increase in Auckland property valuations since 2017. But we're seeing some that are higher. I mean, that's an average increase. And, you know, obviously as an average, there'll be some suburbs that are a lot higher than that and some suburbs that are perhaps a little lower. But we know that valuations can pose a risk. So how do we mitigate that risk? We only take valuations from people we know that know the market. So people we trust, people we've worked with before. We've got some valuers we've worked with for a very, very long time. And you know, they're not afraid to have a robust debate at times. Well, not really a debate, but we aren't afraid to call a valuer and say, have you considered this? What did you think about that? How's this work? We also look at what's the valuation come through for. So if it's for, say, construction or for land, they always do what's best use. So best use on a valuation is often land value. So they'll put a low valuation on the dwelling and a higher valuation on the land. But then we will also ask them to say, is there any value in this dwelling? So then they'll go through and actually do a proper assessment or good assessment on that to understand what's the dwelling value, because we need to have those valuations to be able to give to our investors for you to have confidence in what you're choosing to invest in. And we're also finding that just that conservative approach that we have always had gives us the best lending decision. And we also know, like I talked about earlier, we want to know how these guys are going to exit, and is the valuation going to let them achieve that exit as well. But you know, their preference is to have that information from independent valuers. We'll also do our site visits over and above that. But sometimes it may be a very, very low LVR loan. They may come through, they only want a 25, you know, the loan to value ratio, for those who may not know what that is. Say the property costs $1 million, they want $500,000 as the loan, that makes the LVR 50%. So it may come through it being 25 or 30%. And we might go, well, you know what, we don't really need a full registered valuation. That's quite a high cost for the borrower for that. So we may get a real estate appraisal, which means the real estate agent will go and visit the property. They may take one or two of their colleagues and they will give us an appraisal on how much that house is worth. We may also look at information from a sale and purchase agreement, you know, and try and validate that to understand, did they overpay? Was it an auction? Was it negotiation? How did they buy this property? So we get those S&Ps from everybody. You might get a rating value or a CMA, a comparative market analysis. So that estimates the value of a property by looking at similar recently sold properties in the same area. So there's plenty of ways to get that valuation. So we always take the lowest valuation if we have multiples, and then we'll often take the GST off that. And I'm not going to get into the whole GST thing now, but You know, we do generally will take the GST off, especially for development properties. Then we'll assess it on the GST exclusive amount. So that's how we do that. So, you know, continually rising valuations, or whether they flatten out or they drop back a wee bit, it's anybody's guess, as Christina was talking about earlier. But it makes us stick to our knitting of being conservative lenders. And I think that's really important to note. I think on the scale of conservative versus super aggressive, we're definitely down at the conservative end of what we do. The balance for us is to make sure we don't fall into that sort of that safe territory, you know, when you're kicking out every single loan possible for any reason. You don't want to do that. We still got to make sure we're here to run a business. But we are definitely conservative lenders, have been for 25 years, and that's not going to change. So look, in a nutshell, that's some of the trends that we're seeing. We are in constant contact with financial advisors. We are in constant contact with builders, with developers. We do have an ear to the ground to figure out what's going on, to make sure that we only have the best available loans for our lending side, which then turn into the best available investments that we can get for you, our investors. But if you have any questions, either type them, you can either type them out today, or please feel free to give one of our team a call. Ross and Simone, our relationship managers, Heather being our investment manager. Heck, ring me up if you like. They've probably got more answers than I do, but I'm always available to have a conversation with anybody as well. So look, Heather, that's it for me. There we go.
Fantastic. Thanks, Cam. Some really excellent information there. And just want to remind everyone too that it is our 25th year of being in business as started as Southern Cross Finance Limited 25 years ago with Barry and Julia. So I think you could fairly say that we've learned a few things along the way. And it's that experience that we bring to the business every single day. So again, got questions, drop them on an email. You can email Ross or Simone or myself if you've got our email address, or you can email investments@stpartners.co.nz. And I really want to particularly thank Christina for her time and her insights today. Always a pleasure, Christina, and I hope you all stay safe. Keep Omicron out of your family, and we look forward to hearing from you again. So thank you very much. And we will be sending this webinar out as a recording on a newsletter sometime this week. So you'll get it, you can review it, and you can share it with your friends and family too. So from all of us, thank you very much, and see you later.